Now, let's try to look at a few instruments which are useful for short-term borrowing and lending purposes. And in that, one of the major things that we need to understand is the money markets is a traditional market which deals with buying and selling of short-term instruments. The market that exists typically for maturities less than 1 year is treated as a money market, and the market for the securities whose maturities are greater than 1 year, we call that as a capital market. So whenever we are dealing with the money markets, our intention is short term instruments for buying and selling. And just to understand a few important aspects of the money market, it's not a physical location, it's a virtual marketplace which is majorly participated by the banks, the various dealers who act as buyers and sellers, they are called as dealers, and various corporations. These are the major players in the money market. It's a virtual marketplace. So no physical existence, and all transactions happen electronically through computers and the telephone lines. Now this is the typical characteristic of the money markets. And what we generally see is all of them, all the buyings and sellings happen for a maturity of less than 1 year, but the value which is exchanged, the amount that is traded is a very high value transaction. That's where we call these as wholesale level transactions. So only major players get into these kind of markets, and the kind of value of the transaction that is exchanged between them is a very high value transaction. If that's the case, how can a small investor like me get into the money market? And this is where the solution is through the collective investment vehicles like mutual funds, which will typically pool the money from various small investors, and they make a very big amount. The pooled money from various small time investors and small time companies, that is typically pooled up in the form of a fund, and that is what is taken as one entry into the money market. So one major player is the fund company, the investment company which collects the small time investments from small time investors, pools it, and that plays one important role in the money market. So that will become a high value transaction again. So a small investor can very well invest in the money market through this collective investment vehicles. And as a person, if I look at what are the different ways in which I can invest in the money market, either I can invest directly, I take the help of a professional investment management firm who act as advisors. So these two are very much suitable if my investment amount is very large. I have the expertise, go direct. I don't have the expertise on which ones to buy and which ones to sell, when to buy, when to sell, take the help of a professional investment management firm. But if my investment amounts are smaller in number, then I can look at a money market fund as well, which is a collective investment vehicle. And there are international money markets also, where we are talking about a fund which is let's say INR, Indian rupee denominated, but this Indian rupee is deposited in a bank probably in US, which is outside India. So let's say a dollar denominated loan or an investment but I don't invest in a US bank, but I invest that dollar in India. That is called as an international money market. Typically, we see the examples like euro dollar market, where a dollar is deposited in banks outside the United States. A dollar denominated deposits which are outside the United States are called as the euro dollars. Similarly, I can use various such names. I can use a yen-based deposit in banks outside Japan. All these are typically the international money market instrument. The advantage of these international money market instruments is they don't get governed by the regulation and the taxation of the domestic market. So an INR denominated deposit, if I deposit that in an Indian bank in India, then the returns are governed by the taxation of the Indian system. Similarly, the regulations of the Indian system come into picture. But the same INR based deposit, if I do it in a foreign bank, then that is what will come out as an international money market. And that too, the deposit is for a very short term, less than a year, comes under the scope of international money market, and this is not guided by the taxation or the regulation of the domestic market. And so just like any other deposit, even the money market deposits have to attract some amount of interest, and in general their interest is quoted with respect to LIBOR, which is nothing but London Interbank Operating Rate. Right, the rate at which the international banks lend and borrow each other for an overnight for different kinds of time periods, and whatever is the spread that is present, let's say the risk free rate is, let's say, 4%, but the current deal is, let's say, between the two parties for 5%. This 1% is called as the spread, and the spread is a reflection of the default risk that is associated, that is perceived from the borrower to the lender, as well as the liquidity, what extent I can get rid of my position, I can sell off my position without the price getting impacted. And to a large extent, we see that the money markets operate on a discount basis, which means they are not, it's not like you pay 100 rupees now, the interest rate is 8%, so at the end of the year you will get 108. This is the typical interest based payment. But when I say discount based, okay, on maturity you will be getting 100. The face value is what you get on maturity. And today the purchase price which you might be paying is, let's say, 92. So the interest is coming based on the discount to the face value at which that particular product is offered. So it could be some kind of a percentage. If something is assured to pay at 100, but the current price of it is 92, whatever is the interest that is coming out, that is an implicit interest, right? Which means based on the purchase price, the return that is earned on it would be determined. So the returns are based on the difference between the purchase price and the maturity proceeds. Actually, it should be treated as a capital gain, but from the taxing perspective, we still see that the tax authorities look at it as an interest income only. It looks as if I have purchased something at 92 and I am selling it at 100, so there is a capital gain of 8. So there should be a capital gain tax that should be applied on it. But from the taxation perspective, the tax authorities will still look at it as an income and tax the tax based on the income itself, not on the capital gains. So these are some of the important aspects of money markets that we need to be comfortable with. And now, looking at the different instruments that are associated with the money markets, I'll try to first talk about the instruments that are from the perspective of lending, and at the same time I can look at the same from the perspective of borrowing as well. So we can talk about a few money market instruments. When I say money market, it's always a short term borrowing and selling, borrowing and lending kind of a market. So the lending and borrowing happen for a short term. One of the most prominent instruments in that space is a treasury bill, which is a short term borrowing that is generally done by the government of a country. So the very typical kind of treasury bills that are available are a 3-month treasury bill which matures in 91 days, a 6-month one which matures in 182 days, and a 1-year one generally matures in 364 days. And these are the borrowings of the government. The government issues these bills, raises cash from the investors. Right? So the borrower is the government, the lenders are the different kinds of investors. And even this is a very high value kind of a deal. That means major participants again in this market are the banks, large corporations, and the dealers. The typical way this is issued is by the auction, where the bids are called for and the competitive bid will be selected, and the offer would be made corresponding to the competitive bid. Whereas there could be a non-competitive bids also. When we are talking of non-competitive bids, they don't quote the price, but they take the price whichever is arrived through the competitive bidding process. Right? Probably if I say something like this, okay, let's say I have 100 units to offer, right? So the when I look at the purchase price, let's say 58 parties, 58 people, 58 units, they are ready to purchase something. They are ready for a purchase price of 97, and let's say another 25, they are showcasing a purchase price of 96, right? And so let's say these are the ones, and let's say there are 13 non-competitive kind of bids. So overall 83, okay, and there are four of them, right? There are four of them who have quoted for 95.5. Now, what will typically happen is these are the competitive bids. Different parties have quoted different amounts. They are ready to purchase it at 97. These people are ready to purchase it at 96. These are ready to purchase at 95.5. And 13 of them, let's say, have gone for a non-competitive. Okay, 100 units are getting covered here. 83, 87, 100. Now, the government can see, okay, the where is the cutoff. Okay, even let's say after this, if 10 people are there at 90, ready to purchase it at 95, it does not go up to there, because 87 are ready to purchase it at 95.5 and above. So, and 13 of them have placed a non-competitive bid, which means they are ready to purchase it at a price whichever ends up as a competitive bidded price. So this 100 are sufficient, which means the competitive bidding price might be shortlisted at 95.5, and the average price of the successful competitive bids is chosen and is directly put. That same 95.5 can be offered as the price for the non-competitive bidders as well. So this is the way the traditional treasury bill market operates. It's very deep, the volumes are very high, and the secondary market is also very liquid. Frequent buying and selling transactions can happen even after the direct issue from the government. Similarly, whatever is the borrowing that is traditionally done by the large corporations, the borrowing that is generally done by a government for less than 1 year, we call it as a treasury bill. The borrowing that is traditionally done by a corporation for a small period, either through one of the major sources which a corporation uses to borrow for a short term is the commercial paper. It's an unsecured notes, no collateral is kept against it, and it is majority of the times it is directly issued. Very rarely it goes through an intermediary, but to a large extent it is issued directly by the company. And just like a treasury bill, it is issued at a discount, which means no explicit interest is offered. You can see that the face value of it is the amount that is paid on maturity. The current purchase price is what will tell you how much, what is the return during this period. And one of the interesting things with the commercial paper that came out in the last couple of decades is it can be issued, sold, instead of directly issuing it to the public. I can issue it to a lender with a promise that I will purchase it back at a later date for a higher price. I can issue it to raise money right now to a lender. So this will be, so it is like a security here. Though I said it's an unsecured kind of a note, the commercial paper is issued to borrow from a lender with a promise that it would be bought back at a later date at a higher price. The difference between the two will represent the interest in the process. Generally, this kind of a mechanism is what we are calling as a repo transaction or a repurchase agreement. And the commercial paper is one instrument that can be used to raise money through this kind of a mechanism. And an important characteristic for this, it's a bearer document. It does not, it's actually a single name kind of an instrument. So it does not contain the name of the lender. Only the borrower's name is printed on it, which means whosoever is holding that commercial paper, whosoever is having the commercial paper in hand, just like a currency note, it's only a bearer document. The name of the holder of it is not written on it. Whosoever is having it, it belongs to them. Similarly, the commercial paper is a single name instrument where the name of the borrower is written on it, but the lender's name does not exist. Whosoever contains, whosoever has the physical copy of that commercial paper is entitled to receive the benefits on the maturity. So even whatever is the return which is in excess of the risk-free rate of return is an indication of the default risk as well as the maturity risk. So the default risk again is based on the credit rating that is typically provided to that particular company which is issuing this commercial paper. Lot of traditional credit rating agencies like S&P's, Moody's, these all will rate the commercial paper, and the higher is the credit rating, the lower will be the spread or the margin, and vice versa. Then another way of lending in the short term market is the repurchase agreement, which I have already talked about. Let's say A wants to borrow something and B is the lender. A will sell some kind of A will sell some kind of security to B, right? Sell some kind of security. In general, it's a very traditional government bonds or treasury bills, very highly secured kind of an instrument is sold to B, and B will immediately provide cash. But this will be followed, this will be attached with an agreement that at a later date A will pay some additional cash and B will return back the security to A. This entire thing as such is called as a repo. Repo is from the perspective of borrower. Reverse repo is from the perspective of a lender. So the lender is going to provide some cash. So from the lender's perspective, it looks as if he is buying the security for cash from A, who has promised that he will buy it back at the later point by paying an additional amount, and that additional amount is a reflection of the interest. The investor buys the stock from a dealer who in turn agrees to buy the stock back at a later date at an agreed upon price. The very common repos that we see are the overnight repos, and they are very liquid. We have a big market for buying and selling in these overnight repos, right? Apart from these, there are a few more money market instruments like government agency securities, which are almost like government. The companies are almost as uh, as secured as that of the government. They issue the traded securities. They issue the securities. They trade in them almost. They are not government, but almost similar to that of a government, like quasi-government bodies or government sponsored enterprises. They are highly risk free like a government. You see, so they are not treasury bills, but they are almost similar to treasury bills in various aspects. And even their issue process, the secondary market more or less are similar to treasury bills, but because they are not entirely government, the risk involved in them is slightly higher compared to that of the traditional treasury bills, but it should be, that risk should be much lesser compared to that of a commercial paper. Then we talk about the bank time deposits, where a very common popular instrument is called as a certificate of deposit, which is a negotiable instrument generally issued for 1 to 3 month time period. And just like a commercial paper, even this is a bearer document. So the banks want to borrow. Now you see, government wants to borrow, it's a treasury bill. The corporate wants to borrow, it's through commercial paper. And now the banks want to borrow for less than 1 year, it's a certificate of deposit. And in some cases, banks do even a overnight kind of a borrowing, but very common one being a 1 to 3 months borrowing, which is like a certificate of deposit. And what we see is the secondary market is slightly less liquid for the certificate of deposit compared to that of a treasury bill. So which means the liquidity risk is slightly higher, which means the rate of return here should be slightly higher compared to that of the typical traditional treasury bills. And the certificate of deposits can be denominated in the local currency as well as in any other currency as well. Then one more instrument from the perspective of short-term lending and borrowing is a banker's of acceptance. This is a very interesting thing. Now look at this scenario A and B. A has sold some goods to B, and there is a kind of a credit period. 30-day credit has been provided by A to B, which means B will have to make the payment to A after 30 days. The goods are received by B, but the payment has to be made after 30 days. Now, what is the guarantee that B will make the payment? Right? A has supplied the good, but A is having a worry. What is the guarantee that B will make the payment? Now, this is where any good that is sold, this invoice will be made accepted by the bank. Now this B has to make this invoice accepted by the bank. So which will guarantee. So now the bank comes in, it will act as a guarantor saying that we guarantee that B will make the payment after 1 month. So that is called as a bank as acceptance. Bank has accepted, or bank has given a kind of an acceptance that B will definitely make the payment when it is supposed to make. Now that is being provided to A. That kind of an assurance bill is being provided to A. Now what A can do is that bill, it will trade in the market, it will present it in the market. Instead of taking the payment after 30 days, A will raise money now itself, probably at a discounted value. Because now there is a guarantee that B will make the payment. So instead of waiting for 30 days and taking the payment, A will raise the money from the market itself at a slight 1%, 2% discount to what would be received after 30 months. So this is how a traditional banker's acceptance is going to work. Now, from a borrower's perspective, if I look at these instruments, so for every transaction, if one side is a lender, the other side is a borrower. So, the investor of a treasury bill, the investor of a commercial paper or a certificate of deposit, they are from a lender's perspective. Government is the issuer or borrower of treasury bills, or the bank is a borrower through certificate of deposits. The corporation is a borrower through commercial papers. So those are all the different kinds of borrowers. Apart from that, we can talk about term loans, the loans that are taken for a specified period of time. In some cases, for short term, we have evergreen credit, where the borrowing can be done up to a specific limit, generally no fixed maturity period, but they can borrow at any point in time up to this limit. But to get that facility, there is an initial commitment fee that has to be paid by the borrower to get that facility that they can borrow any time up to that specified limit. So more or less similar to that of an overdraft. So this is like an evergreen credit, but there could be a revolving credit as well, wherein the maturity period is fixed, typically for a 3-year period. After that, again, a revision of the entire contract has to happen. So here also there is a commitment, but for that commitment, the commitment fee is to be paid on the whole amount, whether I draw that whole amount or not. The commitment fee has to be made on the entire amount, but the interest payment can happen only on that amount that is being borrowed. Typically, the example goes like a credit card, right? Credit card works more or less in a similar manner, generally issued for a pre-specified time period. The expiration date will be there 3 years, 5 years, whatever it is. And during that period, up to a particular limit, you can borrow. Once you pay back, again your credit limit can get enhanced. So borrowing can typically happen, payback. In some cases, the borrowing limit can typically go up, but the commitment fee is paid generally on the entire amount, but the interest that is getting applied is paid only on the amount that is typically borrowed only. So this is one more way the capital can be raised. Then we talk about a bridging loan. Oh, I want to buy a big equipment, big machine, right? I want to purchase a big machine. Now I need to get a long-term loan for it, but it takes time to get this long-term loan. The approval procedures and all are quite stringent. So if I have to finance this machine, if I need the machine immediately, I'll take a very short-term loan. This short-term loan will fund this machine purchase. But once the long-term loan is sanctioned, I'll use that proceeds to pay off this short-term loan. So this is for a very short-term period, generally until the long-term finance is obtained. For that intermediate period, this kind of a loan is taken, and that is what we are calling as a bridging loan. And in some cases, I can take the loan in an international market, either from one single bank or from a syndicate of banks also. Now, if you look at all these different kinds of borrowings, they differ based on the commitment. In some cases, by taking a commitment fee, the lender is getting into a commitment that he will allow the borrower to borrow up to a specified limit during a specific time period. So the commitment levels from the lender differentiate different kinds of loans. The maturity, if you look at some loans, they are for a very small time period, whereas some of them are for very long term. The interest rates differentiate. In some cases, it's a fixed interest rate, whereas in some cases, it could be linked to LIBOR or any other reference rate which is floating from period to period. And the differentiation could be in terms of the collateral that is being used as a security against the loan. Some of them are completely unsecured kind of borrowings, whereas some of them require a security to guard against the risk of default. Now, different short-term instruments can exist from a borrower's or from a lender's perspective, which can enable the entities like government, banks, corporations to raise capital in the short term and typically help the investors to do different kinds of investment, diversify their investments in the short term situation, right?